Hello, and welcome to today's webinar on defined benefit pension scheme funding. Just a little bit on how we're going to run today's session. I'll be providing a short introduction, following which Chris will take you through the highlights of his paper. You'll be able to submit questions at any time using the Q&A button on your screens, and we'll take as many of these as we can at the end of Chris's presentation. If I could ask you, please, when you are submitting a question, could you please preface that by your name, just for identification purposes when this later appears in the Actuarial journal. Today's discussion is very well timed, with the Pensions Bill currently being considered by Parliament and the regulator's consultation having come out only last week. It's very helpful for us to once again be considering the key principles regarding the practice and regulation of DB funding. The Institute's 2012 paper on discount rates highlighted two key different approaches to valuing pension funds. A matching approach, which is used primarily as a measure of benefit security, and a budgeting approach, used primarily as a means of deriving contributions. To date, legislation and indeed member disclosure has primarily focused on the technical provisions, with TPR guidance and the legislation itself again supportive of a budgeting approach to such calculations. A solvency funding position is also, however, required and is generally included in advice provided to trustees, in valuation reports, and summary funding statements to members. The DWP's 2018 white paper argued that scheme-specific funding regime is not broken, but that there are a small minority of situations where the current flexibilities are abused. The changes proposed by the Pensions Bill will add a third element to the funding calculations, namely the long-term funding target. Many schemes already have such targets in place, although these may not be formally agreed to by sponsors and are currently often not communicated to members. Schemes will now all be required to set such a target and to set out in a new strategy statement their intended approach to achieving full funding on this target over an agreed period. This will include highlighting the intended investment strategy over time, identifying key risks to this strategy, and setting out how these are to be managed. No significant changes are currently posed to scheme disclosure to members, and perhaps after this we can have a bit of a thought about that, given the comments in Chris's paper. The regulator's consultation also sets out a new approach to how they intend to regulate DB schemes, including a description of a prescribed fast-track route and a more bespoke route for scheme funding. They further set out their initial views on the likely long-term target and how scheme maturity can be used to set a timeframe for reaching such a target. One of the ideas they suggest and ask for comment on is whether such a target should be covenant independent. This target would assume discount rates of between gilts plus 25 basis points and gilts plus 50 basis points. Reading Chris's very topical paper, it occurred to me that there were a number of similarities between TPR's proposed long-term targets and his benchmark valuation. I'd like to welcome Chris. Chris was educated at Manchester Grammar School and at Christ's College, Cambridge, where he read economics. He joined Royal Insurance in Liverpool, qualifying as an actuary in 1975, and became Chief Actuary of the UK Life Division of Royal Sun Alliance in 1998. In 2000, he moved to Nottingham, where he was Director of the Centre for Risk and Insurance Studies at Nottingham University Business School. He published research on subjects that include insurance company and pension scheme valuations and management. He has been a member of several committees of the actuarial profession, including the Research and Thought Leadership Board. He has also served on a number of working parties, and this is his third solo author paper he has presented at a sessional event. He retired in 2004, and like many actuaries I know, is a keen cricket fan, who has also written a biography of cricket writer Neville Cardus. Over to you, Chris.
Thank you, Debbie. Thank you very much, and delighted to be presenting here this evening. Research is a major part of the profession. We are very fortunate that this is a profession where many members do research and present it, and it's published in the British Actuarial Journal, free online and an important means of disseminating the latest thinking. That research gives the profession an opportunity to pursue its role in supporting the public interest. And, of course, funding of defined benefit pensions is topical, with the pensions regulator having only last Tuesday issued its consultation document on the defined benefit funding code of practice. And I was really pleased that the regulator in its document, it calls for clarity and an objective funding standard. I fully applaud those as objectives. Starting point, briefly, is we've got a current annual funding statement where the results of 2 valuations are disclosed in the information given to scheme members and, of course, also included in the actual report to trustees. One is the so-called ongoing valuation, where we compare the assets with the technical provisions, and the other is the buyout valuation, comparing the assets with the price needed to transfer the liabilities to an insurance company. The buyout valuation, when you look at the statement to members, the trustees typically downplay its importance. We're not planning to close the scheme. We provide the information because the rules require us to. And a valuation of liabilities on the basis that they will be transferred to an insurer may well produce a higher figure than if the employer fulfills its obligation to provide the benefits. For example, insurers have to meet solvency regulation requirements and impose a profit margin. Hence, many people would say that the buyout valuation is artificial. And this reminds me of the debate on FRS 17, which is the accounting standard for insurance companies. It was originally proposed that insurance company liabilities be calculated on the basis they transfer their liabilities. But then insurance companies said, yeah, but we don't in practice transfer our liabilities. We pay claims and fulfill our obligations in that way. And so the standard was changed to a fulfillment basis. What is the cost of them fulfilling their obligations, not transferring them? I know that this is pensions, not insurance. I know that this is not accounts. But I think that that concept of fulfillment versus transfer is an important one that we can use here. So the problem with the buyout valuation means that it's the ongoing valuation that is the focus in the annual funding statement. And here the assets are typically at market value, and the technical provisions are defined by regulation as needing to be prudent and with discounting at the prudent expected rate of return on the assets and or the gilt yield. What does the resulting funding ratio mean on that basis? The member reads that the funding ratio is 90%. There's no discount rate disclosed there. Say the 90% reflects a rate that is the prudent expected rate of return. But it would be 85% if a more prudent lower rate had been used, and 75% if a gilt yield were used. And this results from the discretion available on determining the expected rate of return, whether to use gilt yields, and the discretion on the prudence margin. I don't think this is meaningful or sensible. And the problem I have is that under the TPR's proposals, it can still happen. So I wonder what happened to clarity, what happened to objectivity. Scheme-specific funding, which Debbie mentioned, that funding regime was recommended by Lord Miners in 2001, and it is clearly the case that employer circumstances are relevant to member security and how funding can best be arranged. The employer may need cash for the business and could use a high discount rate to produce low liabilities. Maybe the covenant is weak. Perhaps there would then be a relatively low discount rate producing high liabilities. But although little evidence in practice that the covenant is linked to the discount rate. But the flexibility in the discount rate and the choice of prudence enables the valuation result to be adjusted to suit employee circumstances. Scheme-specific management is clearly right. The employer covenant is very relevant to managing it. The scheme-specific valuation is dangerous, I believe. It's right to reflect scheme mortality, etc., but not to adjust the discount rate and prudence to meet employer needs. The liabilities which we're valuing, they depend on service, salary, mortality, and so on, not on employer needs. Changing the discount rate and prudence in the valuation in a scheme-specific way means we can fail to understand and communicate the underlying strength of the scheme, and the outcome is that we can fudge the valuation result. I believe that a valuation approach that is consistent over time will provide clarity and help manage the scheme, and TPR says it wants clarity. Of course, is it a problem in practice? Looking at the DWP document, then there are considerable changes in assumed outperformance over time. 13.9% of schemes had a more than 0.75% increase in assumed outperformance for over 20-year gilts from one valuation to the next. DPR reported that outperformance over 20-year gilts, there's an upper quartile of 1.33% and a lower quartile of 0.42%. Further, these differences are not random. The discount rate of 2.892% applied where the deficit and recovery, where there was a deficit and a recovery plan of more than 10 years, but only 2.653% if the recovery plan was over less than 5 years. And some research that I did with my colleagues concerning the assumptions in firms' accounts showed that firms with weak pension schemes tended to use relatively high discount rates and lower salary growth and inflation assumptions. And we were able to identify that even though the rules regarding firms' accounts did limit the amount of discretion that firms can use. So I propose a benchmark valuation, a valuation that would illustrate the security of members' benefits. And isn't that why the fund is built up? It's a solvency valuation, but don't regard solvency as merely something for regulatory purposes, over-prudent and artificial, very relevant to management. It is not intended to be a valuation that assesses the contributions that are needed for the scheme. And that benchmark is then a base from which the effective alternative assumptions can be tested. And looking at the CPR latest document, they say that having a clearer benchmark against which to assess schemes will help the regulator. When thinking what the valuation on the benchmark should be, then I suggest that it needs to be based on sound principles with reference to the actuarial and accounting literature. It needs to be objective and fair and neutral in the sense of not biased to the needs of one party, either the firm or the members. It needs to be transparent and able to be communicated, and it should be feasible for all schemes, including small ones as well as large. I also think that it needs to be prescribed by regulation to avoid the fudging that can come with discretion. And I would hope that it produces clarity to aid understanding, management, and the regulation schemes. First question is, what are the benefits to be valued? And I propose that the benefits to be valued are those that arise on the discontinuance of the scheme. Helps determine the position if the scheme were closed. And I would omit future salary increases, because the benefits from future salary increases are not really an economic liability. And accountants think of constructive or present obligations as needed to justify a status as a liability. And arguably, salary-related increases are not. We know, after all, that many firms have removed future salary increases from their benefit structure. And this is consistent with the number of papers in the British Actuarial Journal But I do realise that some schemes will wish to fund for benefits from future salary increases, which of course they can do, and in that event they would end up with a higher target funding ratio than if there were no salary increases built in. The value of assets, well, I would propose that we use market value, consistent with much of the movement in actuarial and accounting practice. The alternatives include smooth values and amortized values of bonds, but I believe that they reduce clarity and can lead to inconsistencies. The market values may be wrong, you could say. So the valuations do need risk sensitivities to show what would the assets and liabilities be like in the event of alternative economic conditions. Moving on to the valuation of liabilities now, do we have the fulfillment basis or the transfer basis? For the transfer basis, the buyout cost is not appropriate if the firm intends to fulfill its obligations. And we know that when it is disclosed, trustees tend to downplay its importance. We should therefore calculate liabilities on the basis that the employer will fulfill its obligations. This then leads on to the next question, which Debbie alluded to. Do we use a matching approach or a budgeting approach? And the report of the discount rate project is important. And that was a project which covered insurance, pensions, and finance people. And the matching approach that they describe involves discounting the liabilities at the risk-free rate on the assets that match the liabilities. So it's the assets that match the liabilities, not the rate on the assets that the scheme actually has. And they regarded the matching approach as suitable for assessing solvency. An annuity has cash flows that match those of a risk-free bond. And assets and liabilities are largely different sides of the same coin. So the conclusion is then that we should discount liabilities to risk-free rates such as gilts. Alternatively, we could use swaps, allowing for default risk, and there may be other asset yields that we could use with some adjustment. In contrast to the matching approach, the budgeting approach will discount at the expected return on the assets, which could help to assess contribution rate. Now, my conclusion that the matching approach is the one that's appropriate for measuring solvency is not new. I quote in my paper 7 articles in the British Actuarial Journal in the past 25 years that have come to the same conclusion. What about the papers that have said the opposite? Well, there are certainly comments in the papers that have been delivered where people express concern. But the papers that have been published that recommend that we should use the budgeting approach to monitor solvency are actually there. They're on the right-hand side. There aren't any. 7-0. Indeed, if we count the number of authors of the papers, it's 27-0. I'm told that there is a debate in the actuarial profession as to whether we should use the risk-free rate or the estimated rate of return on the assets to discount liabilities. Well, if I look at the published papers, that result seems to have been decided. Do we need extra time? Do we need a super over? Well, I'm not quite sure. But the Cowling et al. Paper of 2012, the discount project, concluded, as I have it there, for the purposes of estimating pension scheme solvency, a matching framework should be used. If the actuarial profession wants to come up with a different conclusion, then we really ought to finish the debate off quickly and make sure we have that conclusion. I believe that the conclusion is already there. So what about discounting the expected rate of return? This is a budgeting valuation relevant to assessing the contributions required, though of course with the risk that the assets will fall in value. Significant judgment is clearly involved. Would you impose a maximum on the expected rate of return? How optimistic can you be? What do you do about unfunded schemes which have no assets? Because the bigger point is that the liabilities depend upon service, salary and mortality, etc. They don't magically go lower if you switch to assets that you think will give a better return. And discretion and the undefined prudence can lead to fudging the answer. My conclusion is that for monitoring funding, you don't discount using an equity risk premium that may not happen. What about the budgeting approach in member communications? I've already referred to the annual funding statement and my concerns. In the discount rate project, the comments were, from the member's perspective, this information, the funding ratio using the technical provisions, is of limited use. In disclosing the funding position to trustees, regulators and members, the focus should be on the solvency position and how it is expected to develop. And the paper in 2017, using the budgeting calculation, gives misleading information about the security of members' benefits. And this is important. 25% of schemes use outperformance over gilts of at least 1.33%. I believe that the profession's public interest role means that we must press for change. But we can also reconcile the two approaches. And the very interesting paper by Hatch et al. In the BAJ 2013, their example is, well, you have a scheme with a market value of assets of 57. The liabilities discounted at a risk-free rate, 4% per annum gilt yield, give 67. So we have a deficit of 10. If you did the budgeting approach, then you would say, well, 50% of the fund is in growth assets, yielding an extra 3% for 5 years. And that gives you 4.8. So the contributions you need are 5.2. So in other words, changing to discounting at a risk-free rate needn't lead to an increase in the deficit repair contributions. What about these cash flows that are actually uncertain? Shouldn't we add margins for prudence? Well, I believe that prudence in managing the scheme is right. We've got people's pensions at stake. We don't want to be reckless. But prudence in management does not mean that we should be prudent in the sense of having margins that increase liabilities above their expected value. It might lead to unwarranted complacency. Indeed, exaggerating liabilities may have undesirable effects. And discretion on prudence means that the answers are less easy to interpret, and changing the prudence hides what's happening and allows the results to be fudged. And an interesting perspective on prudence is given by the International Accounting Standards Board, who define prudence as the exercise of caution in making judgments under uncertainty. It does not mean that liabilities should be overstated. So I therefore concluded that the valuation in the benchmark should use the expected cash flows without margins for prudence on top. And some people refer to a risk margin. A risk margin could be added to the liabilities to reflect uncertainty. Quantification is not necessarily easy. Various possibilities, such as types of value at risk. And some would suggest, rather than probabilistic measures, using stress tests, although with judgment needed on how stressful they should be. Or maybe the buyout cost. If the assets are there to provide security in the event of the employee's insolvency, what happens in that event is important. It's the buyout cost that matters, and its disclosure, as we have it, can be helpful. So we need to understand risks, but this is extra information, not part of the reported liabilities. That would mean overstating them. I mentioned some other considerations in the paper. The first one is that we recognise that pensions are illiquid liabilities, And so there could be an illiquidity adjustment to the discount rate, which I believe is acceptable in principle, but it's difficult to assess and may be small, and perhaps some further research on that would be helpful. I would make no allowance for the employer's credit risk. We need to compare the assets with the benefits that are expected and defined in the contract, and don't reduce liabilities for employer insolvency risk. And we should use the expected values of future cash flows. And I would say that they should be probability weighted, more appropriate term than best estimate, and without a margin for prudence, which avoids the problem of defining what a prudence margin should be. But back to risk, and to deal with risk, the trustees could prefer that some margin for risk were included within the fund. Arguably, that should not be a regulatory requirement. There's no objective answer. What is right depends upon the circumstances of the firm. And proposals for a risk capital requirement under amended directive were rejected. We do need risk disclosures, stress tests, which could be relatively straightforward, such as using the pension protection fund stresses, or some kind of stochastic analysis. And so while I can propose constraints on valuation assumptions, the really important job for the actuaries is using their judgment to assess and manage risk. What do regulators do? Well, of course, at the end of the day, the regulations are a political decision, but actuaries do have a public interest role to advise. I believe that the DWP should change the regulations in order to require discounting at a risk-free rate for the purpose of assessing security and disclosure to trustees and regulators and members. And that is strengthening workers' rights and should continue to require disclosure of the buyout cost. Regulators need a new process, therefore, for possible intervention. I appreciate that the psychology of a target rate under 100% is difficult to accept, but immediate action to restore 100% funding is probably not the right answer. It depends upon the circumstances of schemes and firms, where the employer covenant is clearly critical. And I applaud TPR for looking to develop a more structured approach as regards that intervention. What do I conclude from the research? Well, I believe the way ahead to tell us about the security provided by a scheme is a valuation that discounts at a risk-free rate, possibly with an illiquidity adjustment, and uses the expected cash flows without margins for prudence or risk, together with disclosures of risk and the buyout cost. I believe that we need to reduce the flexibility and the fudging that can result. And I'm in favour of constraints if they lead to clarity and consistency. And I therefore propose a new benchmark valuation from which alternative assumptions can be tested as appropriate. And I believe that that gives the potential for better quality information, better management, and better regulation. So last week I decided I ought to add a slide about the pensions regulators consultation, and to be fair, I cannot properly do justice to a 175-page document in one slide. There's a great deal of work gone into the consultation and lots of detail. So I just pick out one or 2 points. It sets a low dependency funding basis involving discounting at rates that gilts plus maybe 0.25%, applying to a mature scheme. And it seems very close to what I'm suggesting as regards discounting at a risk-free rate, and it shouldn't be too difficult to make a suitable comparison of the two. The technical provisions, though, can continue to be calculated using gilt yields or expected rate of return, and that can be okay to use in the fast track procedure provided they're at least a specified percentage of the low dependency funding basis technical provisions, depending upon covenant and duration. There are alternative ways of expressing that are suggested. And I make one extract from the TPR's document. Covenant strength should underpin the assumed level of risk in the technical provisions. There's also a bespoke basis, and I'm not intending to go into that. But I suggest that TPR's technical provisions are not really liabilities. They're the level of assets it regards as satisfactory, equivalent to what it thinks is an acceptable recovery plan. So, what might I then add as my conclusion? Well, I would expect that the actuarial profession should, in its response, highlight to PR the research in the British Actuarial Journal. That's what it's for. We do research, we publish it, and then that should form a contribution to how we respond in terms of public interest matters. And I would expect the IFOA to say that the right thing to do is the funding to discount at a risk-free rate, and that using the expected rate of return may work for assessing contributions, but it doesn't work for monitoring funding. It's inconsistent with basic economics, it results in misleading information for members, and the discretion available can lead to fudging. And TPR wanted clarity and objectivity. And I hope that my proposal for expected cash flows without margins for prudence or risk would also be part of what IFOA were happy about. But I would also say that to regard technical provisions as acceptable assets fails on clarity. The technical provisions are no longer a suitable measure of liabilities. The asset mix and employed covenants are irrelevant to determining the liabilities. And so if we want an actuarial evaluation of assets and liabilities, then I do think this is seriously unsatisfactory. And CPR is right to say what might the unintended consequences be. And I will also focus members' disclosure on the relationship between assets and the low dependency funding basis technical provisions. At the moment, from what we see in the consultation document, there might be a disclosure of a scheme that is fully funded, but it's only 74% funded on the basis of using the low funding dependency basis. I don't think that is right as regards members' communications unless we actually start doing things a bit differently. So I've said there what I think the right thing to do is. I just want the actuarial profession to do the right thing.
Thank you very much, Chris. I'd like to open it to any questions from the audience. Please do type your questions in. Chris, while we're waiting for questions to come through, I think you've given a very comprehensive summary of why you see the benchmark approach and the risk-free approach as appropriate for security. You touched quite briefly on contributions and how those are determined, noting that you could use expected returns in some way to do that. Mm-hmm. For most valuations that I'm involved in, that is the key outcome of the valuation from both the company and the trustees' perspectives. Perhaps you can talk a little bit more about how you see that working and how you see that in any way being different to the current environment in terms of the flexibilities, or if not, that currently exist, because clearly the more you assume for the investment returns there, the lower the contributions. The outcome in terms of results seems to be not that different to the current technical funding approach.
Yeah, I mean, I'm perfectly happy that schemes can make assumptions about future expected returns on the basis of the assets that they hold and expect to hold. And that is important for determining the contributions that should be paid, which, as you say, is a key issue. That's what firms want to know. They want that they are required to pay into the pension fund. And I think that is one question and one answer. And another question which needs an answer is, how secure are members' benefits? And then I would discount the liabilities using the risk-free rate. And then that would be disclosed to members. And I think that I, as a trustee, would want that information. It shows me on a consistent basis over time how the scheme is faring. The scheme is prepared. If the scheme is prepared to take risks with its investment strategy, which it may well be, then we want to monitor what the outcome is and how how secure the members' benefits are. And that's where the discretion in the assumptions about expected rate of return, the discretion about funding, and I worry about, whilst I'm perfectly happy with scheme-specific management, I worry about scheme-specific valuation if that is intended to distort the valuation results, as I would see it, to meet employee needs for today's cash flow.
Thank you. Please do submit any questions online. While we're waiting for anything further to come through, you didn't really touch on something you talked in your paper about minimum cost, and a debate that I know has been had before about whether gilts or swaps should be used, and I think I'm perfectly supportive of the idea of minimum cost. I'd make an observation, though, that in my experience, particularly over the last couple of years, when asking insurers for valuations for pensioner liabilities, those valuations and those buyout costs have sometimes come out at less than, I suspect, your benchmark valuation for those same liabilities would be.
Well,
and just wondering whether you would apply that same minimum cost approach to doing that, or whether you would say that is not relevant information.
Well, no, I'm conscious that I've written a paper in accordance with principles, and what I would really like to know is what in practice does that mean in terms of numbers. Mm-hmm. So the CPR has put forward its proposal for a low dependency funding basis. I don't know how that would compare in practice with what I'm saying as regards the risk-free rate of return. And I refer to the debate about should it be gilt, should it be swap, should it be minimum cost. Mm-hmm. And I have some sympathy with it being minimum cost, but I can see that there are some issues. I can see that there are also issues about an illiquidity adjustment. Mm-hmm. And I'm not in a position to do the calculations and compare them, but I think that that is what it would be useful to do, and have a series of figures, mm-hmm. and then that would inform, and then we can also compare that with what, as you say, insurance companies might be quoting. And that numerical research, as opposed to my research based upon principles, I think that the numerical research is also needed, mm-hmm. so that we can then have a more concrete basis for coming to a decision.
Thank you. While we're waiting for further submissions, we've had a contribution from Stephen Rees that, if you'll allow me to, I'm going to read out. Stephen, I hope you're listening online, and I hope I get this right. Actuaries have a tendency to over-engineer things. For pensions actuaries, I believe that it is useful to remember that there are really only two calculations that we ever do, setting aside calculations that are prescribed, such as IS 19 or the PPF valuation. And these calculations answer one or other of two simple questions. What do we think is going to happen over the future? And what would happen if there was no long-term future and we had to settle the pension scheme liabilities now? These two calculations are often labelled as an ongoing calculation and a discontinuance or solvency calculation. The times when we get into a mess are the times when we try to combine these two distinct assessments. The current legislation fortunately reflects the approach of recognising the two separate questions and their separate calculations. It uses the unfortunate expression technical provisions in relation to the ongoing calculation, which is slightly unhelpful, but it does separately require the actuary to estimate the solvency position. The legislation, the regulations, and the work of the pensions regulator give much more prominence to the technical provisions and the ongoing position than to the solvency position. This might or might not be appropriate, but I'm sure that it reflects four things. One, the ongoing position is the more likely one, 2, the ongoing calculations are more subjective because they deal with the reality that the future is uncertain. 3, the ongoing calculations make a difference to the contributions to be paid into the scheme in the future. And 4, the actuary provides advice but is not the decision maker. During the late 1990s and early 2000s, there were many disagreements within the profession, often linked to papers referred to in this paper. Many of those papers did not command universal acceptance and indeed generated much argument. The IFO then instigated the project that led to the 2005 paper that is so often referred to in this paper. The main thrust of the 2005 paper was that it encouraged actuaries to consider where they were completing budgeting calculations, such as an ongoing calculation, or a valuation calculation, such as a solvency calculation. It was therefore very consistent with the legislation on scheme-specific pension scheme funding that had recently been enacted. It explained that the way that an actuary chooses discount rates should be different in the two situations. I apologize for the boring summary of history, but it explains why I disagree with the two main elements of the paper. 1, I do not agree that pension scheme funding should be based on a solvency calculation. And 2, I do not agree with the proposed approach to completing a solvency calculation. We have a well-established insured annuity market that is used in 99% of cases where a pension scheme does have to settle its liabilities, unless it has to use the PPF. I see little value in calculations based on similar risk-free investments, adjusted for reinvestment risk, liquidity differences, assumed mortality rates, etc. The annuity market offers the perfect market-consistent calculation, and indeed I believe that solvency advice not based on the annuity market would often be bad advice. Instead, I support the pensions regulator in continuing with its work on how to make the scheme-specific funding system work better. I want the profession to contribute to that process of improvement rather than to pretend that an artificial single calculation provides good advice for the different circumstances of different pension schemes. Whilst I disagree with most of sections 3, 4, 7 and 10, there are, however, two areas where I think that I agree with the paper. One is that we allow our advice on solvency to be given too little prominence. The solvency position is often unwelcome information for both the employer and trustee clients, and we do need to find a way of rectifying this. Perhaps the next point will help. My second area of agreement is that the quality of information provided to scheme members is typically very poor. I agree that it ought to be based more on the solvency position than the ongoing position, obviously with carefully crafted explanations. However, I would not communicate it in terms of actual numbers. I would communicate it in terms of benefit amount. Quite a lot there to comment on, Chris, if you wanted to pick a few things there.
Well, I think clearly we can't have one valuation that covers all questions, that answers all questions. So we do need more than one valuation, or if you like, we need valuations with alternative assumptions. And I hope I've been quite clear that for the purpose of assessing contributions, then using the expected rate of return can be the right thing to do, provided you understand what the investment risks are. I think the confusion is as regards not the ongoing valuation, what is sometimes referred to as a discontinuance valuation. So what this comes down to is the difference between whether you are transferring your liabilities or whether you are fulfilling them. So in the insurance context, the original idea for accounting for insurance liabilities was, what is the market price if you transfer your liability to someone else? And insurance companies said, yeah, but that will produce an artificially high answer. So in practice, we fulfill our claims. And so the development was of the fulfillment basis for insurance liabilities, which involves discounting the expected cash flows at a risk-free rate. Now, in a pensions context, if you were to tell me that employers are not expecting to fulfill their obligations and that they will transfer them to an insurance company, which of course many of them are doing, although many of them obviously are not, then if they were all transferring them to insurance companies, then that would be the relevant measure of the liabilities. for that purpose. But you look at the funding statements that the trustees issue, and they say things like, but we're not intending to close the scheme. We're not intending to transfer the liabilities. The insurance company's cost is artificially high because they've got to meet solvency margins. They've got to make profits. Therefore, don't take much notice of it, is the implicit comment with it. Therefore, the alternative to the ongoing valuation is not so much the discontinuance valuation, but the cost of fulfilling your obligations in the ordinary course of events. And that involves discounting at the risk-free rate with no prudence margins on top. So I say that the discontinuance valuation is a measure that could suitably be disclosed to indicate risk, because if things go pear-shaped, that is what would be needed to transfer the liabilities to an insurance company. But a fulfillment basis is the one that's in between, that is more reflective of current circumstances. So we have the ongoing valuation, which is a budgeting calculation to determine the contributions for the scheme. We have the discontinuance basis for transferring the obligations to an insurer, but that latter is arguably too high, and that's what many people say, as a fair indication of the liabilities that the employer has. So it's the fulfillment basis that is the proper alternative to the ongoing basis, which involves discounting at a risk-free rate. Now again, I'm perfectly happy to accept that it would be very good to have some calculations in front of us to show us what numbers would typically come out in practice. But as I say, the principal issue that I have is that we have two valuations at the moment, the ongoing and the discontinuance. But what we don't have is the valuation on a fulfillment basis, whereby the pension scheme fulfills its obligations in the ordinary course of events.
I guess the comment I would make to that is that for an insurance company, the fulfillment basis makes a lot of sense, and that's what most are intending to do. But one of the big differences between insurers and pension schemes is scale.
Mm-hmm.
So the largest pension schemes can operate like insurers and do have the sophistication and the scale to do a long-term runoff that would essentially work like an insurance company would work in terms of running a low-risk portfolio over a long period of time.
Mm.
Most small schemes don't have that scale. So for most small schemes, fulfillment is transfer, because that at some point becomes the only way they can cost-effectively settle all the liabilities,
Sure.
because it would just make no sense for them, given their scale, to be able to run off the scheme, if you like. And perhaps that's where the solvency basis for, I can't remember the regulator's stats, but the number of quite small schemes is
Sure.
huge. And for the vast majority of those, that would seem to me that that's where those two coincide, perhaps differently to in an insurance world where the scale and transfer is just different.
Yes, I mean, that may well be fair. I mean, what I would be interested to see would be the, I have looked at a number of annual funding statements, and so the comments I've made about these things are not very relevant, etc., are fairly common. It would be interesting to look at what small schemes are saying in their annual funding statements. Yeah. Maybe they are saying that this is relevant.
And I think what you're highlighting, and I think we're all agreed on, is that what's communicated to members is often lacking. I would say what those schemes are saying on their trustee boards and what the trustees are saying amongst each other is probably quite different to what's reported to the members.
Yeah.
And I do think the new regulatory focus on this new strategy statement is going to bring a lot of that, make a lot of what's implicit, and perhaps discussed quietly within trustee boards, a lot more explicit, and might help with that communication going forward. We have had quite a few questions coming in. Apologise, there was a technical hitch, which meant some of them weren't coming through initially, but we've certainly got quite a few now. Perhaps to start with one from Mark Shaw of GAD. How would you apply the solvency approach outlined in the paper and presentation in a possible regulatory regime for super funds?
Right. I regard liabilities as liabilities, and it would be wrong if we had liabilities calculated in different ways for the same thing, if that was then going to produce regulatory arbitrage. So if you've got a set of liabilities which are currently under a pension scheme, but they might alternatively be under an insurance company, or they might be under a super fund. So in the pension scheme, I would value the liabilities as I've said. And I would also add the comment that I think that the basis that I have proposed for a pension scheme, for the pension scheme itself, that those assumptions would be suitable for the IAS 19 valuation. So if people get concerned about we're multiplying the number of valuations to be done, I've reduced that by one because you would use the same thing here for IAS 19. If the liabilities are transferred to an insurance company, then the insurance company would show its liabilities in its account in accordance with the standard IFRS 17, which, since we're dealing with no salary increases here in a transfer situation, the IFRS, the insurance company accounting basis, is again very similar to what I have proposed here. Mm-hmm. The main difference is that IFRS 17 includes a risk margin. I have alluded in my paper to the fact that I think that risk margin does not make sense and should not be there, but that's another story. Insurance companies then have to comply with Solvency II, and that means calculating things differently, and that's essentially saying that there needs to be further money to provide the capital backing in the event of problems, adverse events. For a super fund, then I would say that the liabilities should be calculated as I have here, so that we have liabilities are the same wherever they are. But in terms of the extra amount that a super fund needs to hold above this benchmark, then that's a matter for the regulators to come to a conclusion on, and it will come to a conclusion as regards that would be a lower amount of capital backing than for an insurance company. The consultation document that was issued did have a number of suggestions, and unless you want me to, I won't go into the detail here. No. And they were largely concerned with stochastic modelling. I might add that the TPR document gives more weight to stress tests, and I wonder maybe that when it comes to regulation as to whether stress tests might play more of a role in determining the super fund capital requirement.
Right. Thank you. Jerry Devaney has asked, doesn't your proposed illiquidity adjustment bring with it its own fudge? And are you really recommending a fulfillment basis that does not reflect how a particular scheme or sponsor actually intends to fulfill that promise?
As regards to the illiquidity adjustment, then that is a difficult area, and I acknowledge that, and say that further work is needed to establish what it might be and how it might be calculated. And indeed, TPR has put forward a basis in terms of gilts plus 0.25% or 0.5%, and it may well be that, well, I say my view is that it would be helpful for TPR to actually come to do a comparison of its low dependency funding basis and a risk-free valuation, and look at what an illiquidity premium might or might not be. And if we're talking about a conclusion that's whether it's 0.25% or 0.5%, then I think the illiquidity premium would play quite a small role in that. But I think some research would be needed to come to a conclusion on that. And whilst at the moment I'm not clear on what that illiquidity premium would be, I would hope that the research that went on would actually come to clarity so that we would have clarity. You have to refresh my memory as to what the second part of the question was.
Okay, second part of the question was your fulfillment basis. And the question, well, I'll just repeat the question. Are you really recommending a fulfillment basis that does not reflect how a particular scheme or sponsor intends to fulfill that promise?
Well, I can see that if the sponsor intends to transfer to an insurance company, then that's the relevant thing. I mean, I can't remember quite what I said in the paper now, but yeah, clearly if the employer has decided that it will transfer the liability to an insurance company, then that transfer basis is the appropriate one to use for liabilities. I'm not quite sure what the different ways of fulfilment might be.
I think perhaps, yeah, I mean, I'd suspect that he is referring to investing in assets that have some risk attached to them.
Well, no, I think the assets are irrelevant to determining the liabilities.
Yeah, but I'm guessing, yeah.
No, I think the fulfilment, the way that they're fulfilled is fine in terms of how we're going to invest the monies. And you need that to assess the contributions, but you then need to take stock to say what's happened, where are we, what security have we got? And that's where I think the basis I've described is relevant.
One from Danny Vassilides. The distinction we need to make clear is the purpose of evaluation. The triennial has become a budgeting exercise, and there's nothing wrong with that. But its use for communicating funding levels is misleading. So is the accounting standard. I think there he and you are agreed. But he asks, are there any unintended consequences of communicating solvency?
Well, I think the TPR has said, in terms of its proposals, are there any unintended consequences? And so whenever you introduce a new regime, that's a question that you need to ask. I think my starting point would be that if you are clear at the outset, and if you've got a proper justification for it, clarity and objectivity, then I think that, I would say that I think the basis that I have proposed is the right one. Then I would think that the consequences are more likely to be right than if you start off with something that is not really right, and might look okay to start with, but it's more likely to go wrong. So in terms of the minimum funding regime, when that was introduced some years ago, it looked right at the outset, but it wasn't really sound, and so it went wrong. So I would start off with, if the proposals are sound, then I think the consequences are more likely to be sound. But yes, I agree, and as TPR has said, we do need to think through, are there any unintended consequences?
Thank you. John Spain question. Together, the words prudent and prudence appear 38 times in your paper, he claims. Where is the best estimate against which alone prudence can be determined?
Well, what I have said is that the cash flows that should be used are the cash flows that you expect to incur. And that should be in principle, probability weighted. So, what are the pensions that we expect to pay? What is the rate of inflation that we expect? What is the mortality rates that we expect? And I would expect people to have a view about that and recognise that, yes, there is some uncertainty with regards to what inflation will be, what mortality will be, and in principle you have probability weighted expectations. I would imagine that in some areas such as mortality, you might say, well, our expectation is the mortality table is X, and that would actually be adequate as a proxy for a set of probability weighted expectations. And that's where I ended up with, what do you expect with probability weights attached?
Yeah, thank you. I'm just trying to... question from Kevin Westbroom. Let us suppose that technical provisions currently equal 70 and the scheme is fully funded on this basis, but under the new proposed benchmark measure, it's 100. Do we think it's going to be credible to say to members that there's a deficit of 30, but no contributions are payable because they will be met by expected investment returns? Which is, I think, the consequences of your having a different approach for solvency and for the budgeting and how you actually determine the contributions.
Well, I showed the slide based on the reconciliation of the budgeting and matching approaches. And I think that the proposal that was in the Hatchett et al. Paper is actually a very interesting one to show how the budgeting approach compares with the matching approach. And you should not immediately jump to the conclusion that we need to increase deficit repair contributions because we've got a deficit of whatever. And if the implication is that the contributions are lower than otherwise because you're investing in growth assets, then of course that may well have a consequence for members' contributions. It may well be that investing in growth assets not only reduces the firm's contributions below what they would otherwise be, but it reduces members' contributions below what they would otherwise be. So, yeah, clearly there's a communication exercise there, but I believe in doing the right thing. If I believe that the right way to measure solvency is using the risk-free rate of return, then that's what I think we should do.
I guess what Kevin is asking is that might be what we should do, but doesn't it make it even harder to communicate to members?
That may be a consequence of the way that we've communicated in the past, which I believe has been flawed. Right. So we have to live with that and get around to what we think is right.
Question from Andrew Smith, which I think I'm going to let you respond. I agree with your summary of the research. You could have mentioned the last paper, which did attempt to justify the use of the equity risk premiums, and that would be Thornton and Wilson's 1992 paper. Why do you think the FA has been slow to accept this science?
Well, I'm not sure that I can give a response on behalf of IFOA. I think that one thing that I've put forward in this paper and in this discussion is the insurance accounting standard, where originally a transfer basis was proposed, and that was changed to a fulfillment basis, where the fulfillment basis means discounting insurance cash flows at a risk-free rate. And I think that distinction between transfer and fulfillment had not really been thought through and emphasised sufficiently before then. And I don't think that it's been emphasised sufficiently in the pensions literature, and that having brought it to attention, I think, gives an extra impetus to moving towards a risk-free discount rate. And it may well be that there's been a reluctance to change approach. Pensions actuaries have been accustomed to two valuations, ongoing discontinuance, and it has been regarded by many people as satisfactory. I don't think it has been satisfactory, and certainly when it comes to member communications, it's not. And I think that inputting the idea of the fulfillment basis as an alternative to discontinuance gives, I say, an extra motivation for saying we need to rethink it. And in my view, that helps the conclusion that Andrew refers. The 7 papers that I've referred to. I did refer to the papers in the last 25 years. And so 1992 was before the last 25 years. It's 25 years.
Yeah. That paper itself was quite a seminal paper in itself.
It was indeed. And I think that things have changed.
A question from Peter Tompkins. I'm concerned at the idea that we have 3 sets of valuations, one for budgeting, the one you propose on matching assets, and the buyout solvency results. Wouldn't this be too many? Your main purpose is to see that members have enough to know to see the right contribution set. I would like to ask if you wouldn't prefer to see just 2, a budgeting one and your new proposal for matching valuation, which could then replace the solvency one.
I think not, because the matching valuation is one that looks at the expected situation with expected cash flows without prudence margins. And I think that we recognise that these assumptions are assumptions, and that we need to have risks. We need to have some risk measures. And I put forward retaining the buyout valuation as being a measure that has a different perspective, with the backup if the employer were insolvent and the employer having to transfer the liabilities to an insurance company. So I think two valuations does not serve it's not adequate. These things are complicated. There are risks, and so we cannot just have two. But as I say, I have, I think, eliminated one because I would put the IAS 19 with this. IAS 19, as I say in my paper, the real problem with IAS 19 is the discounting of the corporate bond yield. Mm-hmm. And when corporate bond yields differed greatly from gilt yields in 2009, it went pear-shaped. But the Accounting Standards Board in the UK has said, we think that the discounting should be at a risk-free rate, and it produces pretty much what I have suggested.
So we've had another question on a very similar basis from Rod Thulis, who notes that in addition to the ones which Peter had listed, there's also a PPF levy valuation, which we're required to do, which is again a different kind of solvency valuation. And his view is that the provision should be pragmatic where possible, and couldn't we just choose one of these bases to meet all three purposes?
Well, I confess I don't know the details of the PPF basis.
Yeah. What I would perhaps comment on just is that the PPF basis is fundamentally different because it doesn't value the scheme benefits.
Yes, indeed.
It values PPF compensation. So from my perspective, that is the one which isn't relevant to anything else. It does actually, and this is perhaps comes into the unintended consequences of what you might communicate on solvency. What it does give is the priority order in which liabilities would be met if a scheme became insolvent. And perhaps one of the issues, I think there are two challenges with communicating solvency numbers in terms of how members speed them. The one is that if you say to a member, your scheme is 70% funded on a solvency basis, they might interpret that as there's a 70% chance that I'm going to meet my benefits, when clearly it's nothing of the sort. Particularly if they've got a strong employer who's able to stand behind the scheme and ensure it's fully met. What's more, and this is where the PPF number comes in, even if it was to go insolvent, everybody wouldn't get 70% of their benefits because the PPF priority order, and indeed the scheme priority order on top of that, would determine what individual members got. And actually, that's a much more complicated communication than that single number would suggest.
Yes, I think that's entirely right. And considerable care is needed in that member communication. And say schemes differ in terms of the way that they are designed in terms of priorities. Is there anything else to add to that?
No, I think perhaps it just recognises.
Oh, sorry, yeah. I think
whichever
on the PPF basis. I appreciate that the PPF compensation is based upon PPF benefits, and you can't get away from that. What I don't know is what are the rules about the assumptions to be made in that PPF valuation.
So they are prescribed bases that are insurance bases like, but not the same as the insurance assumptions. But they're also intended to be a, if you like, matching type valuation basis. I would describe it as that is similar to the insurance basis, but has slightly different assumptions to what you might assume for buyout, and would probably have again slightly different assumptions to what you might have for your benchmark valuation purposes.
I mean, I think that adds to my comment that what I think we would be beneficial would be for one group, and it may be a working party or it may be TPI's responsibility, to actually sit down and say, well, let's take a sample of schemes or a sample of notional schemes and look at what these different measures produce and to what extent there are differences. Are these differences major, minor? What do they depend upon? And I think that would be a helpful contribution to the debate. I mean, I appreciate the concern that are we multiplying the number of valuations and, is this beneficial? And so some research on the numbers. I hope I've contributed in terms of this is the type of basis that I would like, but some numerical, what these numbers produce, what the numbers would be. I think that would be very positive.
Thank you. A question from David Kuehl. Should actuaries be required to include the option value of the sponsor put when advising on the price of future benefits? This would be low with matching investments and high with risky investments. The gross price would be the same, which it should be for the same benefits.
So the initial bit was, the question was,
should the actuaries be required to include an option value of the sponsor put when advising on the price of future benefits?
I mean, I wouldn't say that they should be required to. I mean, my concern was that the benefits to be valued should be the benefits payable under the contract, what the employees are entitled to under their contract of employment in the pension scheme as part of that. As regards what the employer will end up paying out, obviously there will be a proportion of cases where the employer will go insolvent and will not end up paying the contributions that would otherwise be made. And in terms of shareholder value, that may well be a question that the firm would want to ask. And if the firm asks that and wants to know, then I can see actuaries doing some calculations for them. But I wouldn't prescribe that.
Thank you. More on buyout costs against your fulfilment costs, I think. One from Andrew Dodd. Currently, the buyout cost, and I think it's a point I made a bit earlier, is likely...
what cost? The
buyout cost, the solvency cost.
Right. Yeah.
Solvency buyout cost is likely to be less than liabilities on a risk-free rate for very mature schemes because pensioners can often be bought out at gilts plus a margin. For such schemes, how will disclosing the buyout cost demonstrate the additional risk the scheme is running?
I mean, I take the point that there will be some circumstances where, the order of numbers may be different. I should say that there are several schemes where one looks at the annual funding statements and the trustees say the buyout cost will be artificial. Insurance companies have these extra costs. So I would come back to the point that it would be helpful, say, for a number of schemes and a sample of different types of schemes to say, right, on these different bases, then these are the numbers that one would come out with for liabilities. And you then take it from there in terms of informing the debate. That's what would inform the debate, to have some relevant numbers to say this is what's going on in practice. And
I think you'll find that all the major consultancies produce quite significant buyout surveys where they in fact do produce numbers on what they're seeing in the buyout market and what current pricing is. That information is in fact available and generally published by a number of different consultancies. Another question from Stephen Rees. When so few pension schemes could operate independently without an employer, exactly whose question is best answered by a fulfilment calculation rather than a solvency calculation?
Well, the fulfilment calculation is, for the employer that is currently backing the scheme and the employer that expects to continue in business and expects to have the scheme, then fulfilment basis is what is appropriate.
Thank you. I'm just seeing whether we missed any. One from Con Keating for you. How would you respond to the suggestion that the proposed benchmark is just another counterfactual rate in common with the legislated rates and buyout?
Well, I think that what the benchmark is a benchmark that provides useful information on the security of members' benefits, and the employer takes together with the trustees, you take investment risks, and you have the expected rate of return assumption to determine the contributions. But from time to time, you need to take stock, have those risks worked out well. Where are we? And where are we now means comparing the assets and liabilities and taking stock as regards what is the level of security that has been provided.
Thank you. I think that's probably the end of the questions. One more from you, perhaps, and again, I think this is on a bit more on unintended consequences and how members interpret solvency. And it's the idea that you could be using a perfectly consistent basis for two schemes, and they could both have the same funding on your disclosed measure, but one scheme perhaps has a parent who's a AA rated insurer with very healthy solvency margins, and the other is a very small employer that's much smaller than the size of their scheme and struggling to make ends meet. Their security is not remotely the same, even though those numbers appear the same, because clearly the likelihood of insolvency in the one is vastly different than the other.
I mean, I agree. Clearly, there are differences in the. I mean, not what I'm saying is there are differences in the employer covenant.
Well, and it's saying that just focusing on the solvency number doesn't actually give the picture to members in terms of whether their benefits are likely to be met. It's only one element of a much bigger picture.
Yes, but I think it's a number which can be added the context of the employer and how large, how financially strong and how committed they are, and so that context is always going to be part of solvency. But I would augment that context with a number that I regard as appropriate rather than a number that I regard as inappropriate.
Thank you. I think that's brought to the end the questions, so perhaps just a brief summary. I think thank you for a very thought-provoking paper and a great discussion. You've argued about a central measure which you've called the benchmark liability based on risk-free discount rates and, as far as possible, neutral demographic assumptions. You've certainly highlighted the challenges in communicating to members the funding position of their schemes, and I think if there has been something that has received broader support in this discussion, it's that being able to communicate clearly to members could do with an overhaul, if you like, at least in some respects, and that current summary funding statements are not terribly clear or helpful in this regard. You acknowledge that the current sort of technical provisions framework in the sense of expected returns is useful for setting contributions, but you think that the regulatory focus should nevertheless switch to the benchmark return, I think. We've had quite an interesting debate with, I think, challenge perhaps on whether this new benchmark proposal is a useful addition or whether it's simply seeking to replace a solvency valuation that clearly a number of respondents felt still did a very similar job to the job which you're anticipating this to do. And no doubt there'll be plenty of further discussion on that as time goes by. I would also say, just on behalf of the Pensions Board, I'm very interested in any comments people do have on the current scheme funding consultation. Clearly the board itself will be responding to that, and we'd be very interested to hear from any members who have points they'd like to see included in that response to the consultation. Thank you.
Can I thank people as well also
yes,
for their contributions, which has been much appreciated. And if I did have one point to add, it would be that I think something that has come across is that I think it would be very helpful, and I don't know whether it's either TPR or whether it's the Pensions Board, to do some specimen calculations on what both TPR is proposing in its basis, what I've been proposing, and the different valuation bases for different types of schemes. I think that would really inform the debate. And so perhaps that's a further step that could be taken.
Thank you. I would note that TPR in their next consultation will be putting down their actual numbers for their proposed fast-track approach and are promising some analysis to go with that. So it'll be quite interesting to see what comes out of that following consultation later in the year. Thank you.
Thank you.